Well, with US markets closed for the Thanksgiving holiday, there's not much for Australian traders to work off this morning. We have seen sentiment shift very dramatically over the course of this week as Fed speakers were rolled out across the US to talk up the potential for an interest rate reduction next week from the US Federal Reserve. And that, of course, has short-circuited the negative sentiment that saw pressure on share markets in the US and around the globe over the course of November. And it does look like most of the markets are going to finish down between 1% and 4%. Australia was one of the hardest hit markets in that. And despite a bit of a rally this week, it does look like November will record a negative number for investors. So some concerns there. However, the turnaround in sentiment has been quite palpable. There's a lot of optimism around the potential for a rate cut next week in the US. That's pretty cold comfort to the Australian investors, as the inflation data that we saw this week almost guarantees that there's no chance for an RBA rate cut anytime in the near future, at least until that inflation is tamed. So that optimism, though, should see us drift higher today. We're not expecting huge volumes, but there is potential for some reshaping. And of course, with the Black Friday sales starting tonight in the US and some local retailers getting in on the act, we could see support for retail stocks over the course of the trading session today. In markets that were open, we saw Bitcoin and oil edge slightly higher. Gold drifted slightly lower. But that retail support is probably going to be the key feature of trading here in Australia and across the Asia-Pacific region today. There's a lot of talk about the potential for a Santa Claus rally. It's not one of my favourite terms. The quant analysis doesn't really back this up. We do get rallies in December, but because it's such a persuasive narrative or a favoured narrative, we tend to highlight any rally in December and call it a Santa Claus rally. The reality is markets fluctuate, and although we're likely to see some gains, whether or not we'll see a Santa Claus rally is still a very open question. Now, there are plenty of strategists pointing to the idea that a rate cut next week will set the S&P 500 back on course to break through the 7,000 mark for the first time ever. I can't rule out any possibilities. What I would say is we're very likely to see an increase in volatility over December as sentiment fluctuates around the state of the US economy and the potential for support from central banks in the US and around the globe. So it's good to be going into December with positive sentiment, but I think over November we saw how fragile that sentiment is and how dependent it is on central bank action. The big issue for investors is the lack of data about the US economy because of the government shutdown and the failure of the Bureau of Statistics to publish a lot of the data that the Fed and investors rely on to understand what's going on in the US. So as we see more data come through, we could see markets reacting with surprise in either direction over the course of December. That sticky inflation really does stay the hand of the Fed to some extent. It's very unlikely, in my view, that they will be talking interest rates down, even if they do deliver a rate cut next week. But nonetheless, the market's always right. There still remain questions around AI valuations. Consumer confidence in the US is at multi-year lows, and that's a real concern. More than 2/3 of the US economy is driven by consumer behavior, and with consumer confidence at those lows, I think there must be real concerns for the health of the US economy. We're also starting to see the effect of tariffs coming through. We heard from Deere Farm Machinery this week. They blamed the big drop that they saw in their profitability on the introduction of tariffs, and they pointed out that their tariff costs were going to more than double to $1.2 billion next year. If that is repeated across the US landscape, the potential for another outbreak of inflation is very high. And so there are a number of questions, and any movements in December, either up or down, might present opportunities for investors to reshape their portfolios ahead of what could be a very tough first quarter in the US. Turning to our watch list today, featuring retailers, Ulta Beauty. It's reporting next week, and it's up 23% year to date. It's one of the best performing US retail stocks this year. The EPS is down 12%, or it's expected it will be reported next week as down 12%. But with the stock trading nearer lows and a number of analysts putting a buy rating on it, on the basis that they should see a big lift in revenues in the first quarter next year. And many analysts looking for a better than 30% improvement in their revenues in the following quarter. And that might be why so many are maintaining their buy ratings on Ulta Beauty. Turning to a Chinese EV giant, electronic vehicle giant Li Auto. Its third quarter report this week showed a steep loss. Sales were down 36% year on year. Now, this is a higher end EV manufacturer, so it doesn't speak to the whole landscape, but it's obviously not a positive for electronic vehicles. The revenue and deliveries also fell. The stock's up 5% over the last 5 days, but it is trading at lows. It's at the moment rated a strong buy by a number of analysts because of what they perceive to be an undervaluation. But of course, sales are very important. It does appear like the market had already factored in this poor result, and there might be some potential for Li Auto to recover from here. And looking locally, in the spotlight today on our watch list is HMC Capital. Now, technically speaking, this one's classified as a REIT, a real estate investment trust. However, it does more than that. It's involved in development and private investment as well. Now, it's up 10% for the year. It's up 10% at the moment, but it's around 64% down year to date. Another stock that's trading near lows, and that's not common with the market at all-time highs. There are a number of investment banks who are rating this one very strongly, with a buy rating and a target of $4.90, now trading around the $3.50 mark. So plenty of upside according to the analysts. HMC Capital, one to put on your watch list as well.